Most retail trading education begins with the principle of buying at support and selling at resistance, the idea that price floors and ceilings act as barriers that the market is likely to respect. Standard risk management for this strategy involves placing a stop-loss order just above these resistance levels. This ensures that if the price breaks the ceiling, the position is automatically closed to prevent a larger loss. At these same levels, breakout traders place automatic buy-stop orders. They are waiting for the price to cross the resistance line to enter a new long position, expecting the momentum to continue upward. This chart shows how these two groups overlap. Above these equal highs, the stop-losses of short sellers and the buy-stops of breakout traders combine to create a concentrated pool of buy-side liquidity. Frequently, price will push just high enough to trigger this cluster of orders before immediately reversing. The sudden influx of buy orders is absorbed, and the price collapses. This maneuver is a liquidity sweep. It is a targeted move designed to trigger pending orders before the market moves in the actual intended direction. For many traders, this is a recurring source of frustration. A setup that appears technically perfect results in an immediate stop-out just seconds before the predicted move occurs. To understand the mechanics behind this, we have to look at the market through the lens of institutional participants, the banks and firms trading positions worth hundreds of millions of dollars. Large-scale capital does not view a resistance level as a barrier to trade against. Instead, they view these levels as areas where the necessary volume exists to fill their own massive orders. Entering a trade simply because price touched a horizontal line places a retail position directly in the path of the liquidity sweeps required by large-scale participants to facilitate their own entries. An institution cannot simply click sell on a multi-million-dollar position without consequences. At that size, there is rarely enough immediate demand to match their supply at a single price point. If they attempt to sell everything at once, the order will eat through every available buyer, actively driving the price down as it fills. This results in slippage, where the average execution price is significantly lower than intended. To avoid slippage, the institution requires a massive, simultaneous influx of opposing buy orders to act as the counterparty. They need a crowd of people buying exactly when they want to sell. This explains why price is drawn to the liquidity pools above equal highs. The heat map shows that this is where the required volume of buy orders is concentrated. By pushing the market into that zone, the institution triggers the retail buy stops and stop losses. They effectively use the retail crowd's forced buying to fill their own massive sell orders at the best possible price. This mechanic extends to diagonals. An ascending trend line creates a trailing path of sell stops, providing a predictable source of liquidity for institutions to clear out retail buyers before committing to a larger move upward. Market direction is not determined by geometric lines, but by the physical requirement to reach the liquidity pools needed to execute institutional block orders. Beyond simple support and resistance, institutions also use structural traps known as inducements to engineer liquidity near high timeframe supply and demand zones. This chart shows a primary supply zone at the top, but notice the smaller double top forming just beneath it. This secondary structure is an inducement. This structure is designed to draw retail sellers into the market too early. As they enter short positions at this minor resistance, they place their stop losses in the space between the inducement and the actual supply zone. To identify these traps, we look for a specific technical signature, the imbalance. An imbalance is a rapid vertical price move that leaves a gap where no overlapping trade took place. This shows a moment where the market moved too quickly for all orders to be filled. If an unmitigated imbalance exists behind a resistance level, like the gap we see here between the double top and the supply zone, the lower structure is almost certainly an inducement designed to be swept. Blindly placing limit orders at the first zone price reaches often results in a loss because the market is simply moving through that zone to fill the imbalance sitting behind it. Without distinguishing between an institutional origin and a manufactured inducement, a trader is likely placing their stop loss in the exact location an algorithm needs to find its counterparty volume. The solution to these traps is the standard confirmation entry model, a method designed to verify institutional intent before entering a trade. First, the trader must wait. On the higher time frame showed on the left, we do not act until the inducement is breached and the liquidity pool above it has been swept. Once the sweep occurs, we shift to a lower time frame to watch the internal price action. We are looking for a clear sign that control has shifted from the buyers back to the sellers. We look for the price to break its immediate trend. After making a series of higher highs, the market must violently drop through the previous low, creating a new lower low. This is a break of structure, or BOS. It marks the first time in the sequence where sellers have actually overcome buyers on the lower time frame, confirming the directional shift. Only after this confirmation do we look to enter, waiting for price to pull back into an efficient range where previous imbalances have been cleared. This approach trades a higher probability reaction to a confirmed event rather than a speculative guess at an unconfirmed price level. The standard confirmation model allows a trader to stop predicting where the market might turn and start reacting to the footprints institutions leave behind after a sweep. We can see these mechanics at work on this Euro-Swiss franc 5-minute chart during a recent bullish trend. This leg created 3 distinct demand zones below current price. For a retail trader, each looks like a valid place to buy. The first zone is ignored. Lacking lower time frame confirmation and with imbalances beneath it, the market has no reason to stop here. The second zone acts as a clear inducement. Buyers who enter are swept as price reaches deeper liquidity. This leads us to the extreme zone, the origin of the move. It is the only zone where the imbalance is fully resolved and there is no further liquidity left to hunt beneath it. When price reaches this extreme, we see the shift. A break of structure occurs on the micro time frame, providing the confirmation needed to participate in the ensuing rally. Effective navigation of multiple zones requires identifying the underlying structural imbalance and waiting for price to reach the extreme origin point. Retail theories treat trend lines and equal highs as solid walls, but for institutional players, these are the most liquid, vulnerable areas on a chart. Large orders require that liquidity be engineered and swept. Without these sweeps, the institutions that drive the market would be unable to enter their positions. Inducements and false breakouts are the necessary mechanics required for a significant move to begin. Success in this environment requires the patience to wait for the sweep to occur and the discipline to verify the structural shift before committing capital. When a textbook retail setup appears too obvious, it is often engineered to attract the exact liquidity needed by the other side of the trade. Sustainable execution relies on identifying the specific retail liquidity being targeted and aligning with the institutional volume that clears it.